In today's episode, I'm going to teach you the tips and tricks that I've implemented in my own trading to help me successfully time the market. The result of this strategy is that I make substantially more money than a trader who uses fixed positions on every trade they take. But it does require you to learn how to identify these very specific indicators that the market is beginning to shift. Now, if we jump onto the screen share, you'll see here I've got my charts and I've got some scans. But what I want to show you actually is this window right here, which is where I track all of my trading performance. So right here, I've got 16, 17, 18, 19, 20, 21, 22, 23, 24, and 25. So nearly 10 years of trading history is all aggregated right here. And what I can do is I can look very closely at my data to help me understand how I perform. And there's a couple very specific things that I want to point out to you at the beginning of this episode. I want to compare my winners and my losers, the winning trades and the losing trades. It's a very simple comparison. So what we're going to do is we're just going to go year to date. We're going to look at the winners, we're going to do year to date, and we're going to look at the losers. We're going to go year to date. And when I run this comparison, you're going to notice an interesting pattern. You'll probably not understand how it's even possible at first. So what we see here is that my total gain on winning trades is $6.1 million year to date. And my average winner in cents per share is about 17 cents. And my average winner in dollars per share is, or in total profit, is $3,200. Now, that's the winning side. Over here on the losing side, my average loser my total losses are 1.2 million. My average cents per share loss is 13 cents, but the average dollar amount is only $1,600. So what is happening is somehow, and you don't know it yet, but I'm going to share it with you, somehow I've managed to reduce the size of my losers. So $1,600, which is the average loser that we saw right here, divided by 13 cents equals average position size, jump over to the whiteboard, of 12,307 shares. Okay, so this is my losing position size. Now let's look at my winning position size. All right, so on the winning position size, we're going to jump back onto the screen share, and we're going to go ahead and divide 3,200 or 3290. So 3290 divided by 17 cents. So when we divide it by 17 cents, my average position size is 19,352 shares. So how is it that I somehow manage to always have more shares on my winners than I have on my losers? Interesting indeed. That is because of a very specific strategy that I'm implementing. And the result, as you can see here, is that I'm making more money. Now, if we look at the detailed P&L, and I share this with you, not because I want you to assume that my results are typical, because they're not, but I want you to know that the person that you're going to spend some time learning from today actually knows what the heck they're talking about. And this represents more than $19.5 million in trading profits, and that is all real money. So if we look just year to date, I'm at $4.9 million, and you can look at the accuracy right here, which is 71.2%. So out of 100 trades, 71 are going to be winners and approximately 29 are going to be losers. But somehow, I always seem to have more shares on my winners than my losers. Let's imagine you're going to Las Vegas and your friends all want to gamble. You don't really like gambling, you don't know how to play cards. So what do? You go play the slot machine. Now, if you're going to play the slots for, let's just say, 3 hours, and you are hoping maybe you get a jackpot, maybe you get a good turn and you make some money. This is a game that has zero skill involved, no skill. It is pure luck. So the best strategy would be to take the exact same position size, $5, let's just say, and use that for every turn that you take. And hopefully over 15, 20, 30 turns, or whatever the case is, you'll have a couple of wins. So in this case, you're putting all of your hope essentially just into the faith that hopefully the rate of getting a win is like, I don't know, 10%, or it's high enough that if you play enough turns, you'll eventually get a win. But what if you did $5 on 3 turns and then you said, oh, I have a really good feeling that the next one's gonna work, so I'm gonna put in $5,000 on the next one, and you lose. Now, see, that would be a mistake. And I think that for a lot of novice investors, taking the approach of, I just have a feeling that this is going to work, so I'm just going to sort of haphazardly take more risk on this position, will not be a successful strategy. But for them, investing is not really skill-based. It's just based on the faith that over the long term, 5 years, 10 years, 15 years, 20 years, the market will continue to go up. And that certainly is the case. It certainly has been the case. So for me, being a more sophisticated, active trader, I take a slightly different approach. The way I look at it is that if I'm in a market where I'm returning back-to-back big green days, all right, I'm having every trade I take, my accuracy is higher than normal, the stocks that I'm trading are going up more than they typically would go up, and I'm looking around and I'm seeing other people are making more money. Wouldn't I be doing myself a disservice not to take bigger position sizes in this environment? And that's not just emotion, it's not gambling. That is true skill to be able to recognize the current market environment, that it's very conducive and favorable for my strategy, and therefore it's the right decision to take more risk. The result will be that I will make more money. And so when it comes to position sizes right here, this is the way I approach it. Let's jump back onto the screen share and let me show you a real example. So let's see, I'm going to pull up a chart here today. This is a stock that I traded this morning, BSLK. It is currently up a remarkable 554%. This is a beautiful looking chart. This stock has just been grinding higher and higher and higher. Had a long pullback and then just broke out again right here, dipping down and pushing higher. So the way I traded this a little bit earlier in the day, and we can just kind of back up to this area, just for example. So the way I focus my strategy is that I really like trading pullbacks. So when something starts to move higher like this, I wait for the first pullback right here to take what I call is a starter position. Starter position. So what that means is that on my first trade, I'm not taking full size. So let me show you what this looks like. The price moves up very quickly, and then we get a little bit of a pullback right here. And as the first candle makes a new high, right at that spot, I take my starter position of, let's say, just approximately 10,000 shares. Now, if this immediately reverses and drops right back down, I'm going to sell it for a loss. So I'll take the loss right here, and let's just say that was about 13 cents a share, and the loss was around $1,800. So it's got to be 12,000 shares, which was that's what we were at, about 12,000. So approximately $1,800 in the red. Now, if this doesn't drop immediately, so if this happens, then I never add to my initial position to 12,000 shares. I had the 12,000 share starter position, that was it. The position went against me, I cut the loss. But if the position doesn't go against me and it starts to move higher, what do? I add to the position to go up to 20,000 shares. Now we saw that my average is approximately 19,000. That's averaged. So now with 19,000 shares, this goes higher, and I end up making an average of what we saw was 17 cents, which is now $3,200 because, because I've got that bigger position. So bigger position. So I'm adding to winners, not to losers. And this is contrary to what a lot of beginner traders will do. A lot of beginner traders will get into a position, it starts to go down, and their fear of realizing a loss convinces them to hold the position. So now they sit there holding this position as it's dropping. It goes quite a lot lower, and they say, gosh, I'm down so much on this thing, I might as well add to the position. And then that way, it doesn't have to go all the way back up for me to get out break even. It only has to go halfway back up. So now they're taking 20,000 shares on what? Not their winners, but their losers. So this is what a lot of beginner traders will do. Their average position here will be the 19,352 and the, around $3,600 loss. And their average winners will be only 12,300 shares and $1,800, which means they have an inverted profit to loss ratio. They're losing more on average than they're making. The only way this is sustainable is if you can be right 75, 80% of the time. And that's just to break even. Now, look, we saw my metrics. I'm at 72% over the course of the year, just under 72%. And I've been doing this for a long time. By the way, for those of you guys tuning in perhaps for the first time, I hope you hit that thumbs up. I hope you're subscribed to the channel. My name is Ross Cameron. I'm a full-time trader, And I funded my first account in 2001. So I've got a lot of experience in the market. I've had a lot of ups. I've had a few downs. I've gotten beaten up more than my share, fair share of times. It's part of being a trader. But what I'm here to really share with you is this technique that I use to help me time when to be more aggressive. So this is what I look for. When the market is starting to heat up, how do I know it's heating up? I'm going to start, number one, seeing more stocks producing outsized gains. More stocks will be up more than 100%. You can apply this to crypto markets and other markets as well. But we start seeing bigger changes, rate of changes. So today, our leading gainer in the entire market is up over 500% with 200 million shares of volume. This is a really incredible move. This is a stock that came out with earnings yesterday. So earnings, that was the catalyst, and boom, here we go, incredible move. So focusing on trading when we have stocks that are making really big moves and when I'm producing outsized gains. So when I start producing bigger profits, that's when I realize, okay, it's time for me to lean in and take bigger share size. Okay, so that's my cue to size up. What is my cue to size back down? The cue for me to size back down is that first outsized loss. The first trade that I take where, I really think it's gonna work. I have this position, let's say like right here where I go up to 19,000 shares. It feels really good. And then all of a sudden I get caught with this sort of, big red candle that drops back down here, and I give back more than I was expecting. So, and this might be a, $3,500 loss or something like that. This could be, or it could even be larger than that, but it's an outsized loss, bigger than my typical losses. And this is the moment where I pump the brakes. But you know what? That is a sophisticated move, because you know what a lot of traders would do in that moment? They would look at their P&L like this. They would say, well, geez, over the last, few days or few hours, my account's been like this, and I just lost, this amount, this $3,500 or whatever the case is. I'm scared. And I want to get myself back to here as quickly as possible. So the best way to recover that loss quickly is to do what? To trade with bigger size. Now you're trading with bigger size when it's getting colder. Why? Emotion. You're not trading your statistics, you're not trading your metrics, you're trading your emotion. So the simple strategy of using fixed position on every trade you take eliminates emotion. And emotion is one of the biggest challenges in trading, because it's what causes you to hold winners too long, or to hold losers too long, to sell winners too soon, and to take outsized risk at the absolute worst time, because you're feeling fear, you're feeling emotion. So my gut feeling is that as a beginner, you build a foundation on fixed position size. You build a foundation there, because that is the best way to get started. But in truth, you're leaving a lot on the table. So once you've built your foundation and you've had a few months of decent profitability using fixed position sizes, that's when you start to experiment with, on hot days, increasing your size. And it's not tripling it, it's not quadrupling it, but it's going up maybe by 50%. So if you typically trade with 1,000 shares, going to 1,500, just leaning in a little bit more. And what you'll see is on those days, your green days are getting a little bit bigger, right? And then it's recognizing, what is that cue that I'm looking for to pump the brakes and slow down? I'm looking for, ultimately, that first bigger loss. And I'm going to do the exact opposite of what my gut intuition is telling me, which is to size up. I'm going to size down. So here's how I sort of play out having this loss. When I have that first big loss, and I mean, look, I've had times where this has been a six-figure loss. I've had times where it's, a smaller loss. But whenever I have that first loss here, how do I approach it? I reduce my size by 50%. So size goes down 50% size down. And I trade with reduced size until I have what? Made back half the loss. Once I've recovered half the loss, which may take only a couple hours, it may take a couple days, or it may take a couple weeks. However long it takes, it doesn't matter. Until I've recovered half the loss, I stay with small size. And then once I've crossed that point, then I start to size back up. Because what I don't want to do is I don't want to have a big red day, have a small green day, and then another big red day, then a small green day, and then another big red day. But that's exactly what will happen if you keep trading with big size after this moment right here, which is the market cooling off. Now, it is possible that your loss is not attributed to the market cooling off, but was attributed to your cat walking over your keyboard or losing internet or something really dumb like that. And look, trading is hard enough without these things happening, but let's just say it happened. So how do you approach that? You still do the same approach of slowly rebuilding, because in this period here, right after the big loss, it's a little shell shock. You've got a little anxiety because the last thing you want is the cat to walk across your keyboard again and all of a sudden your account's gone. So you've got to just keep yourself sized down, because this is a place where you're at higher risk of becoming emotionally compromised. And so that's kind of this interesting thing about being a more advanced and a more sophisticated trader, is you start to walk that tightrope of getting closer to your emotional comfort zone, the edge of your comfort zone, where you're pushing your share size, you're taking more risk, and you could potentially be having some really big winners, but you get the risk of big losses. However, it is at the edges of our comfort zone where we see the most growth. Now, there's a great book here I'll share with you. This one's called Quit, The Power of Knowing When to Walk Away by Annie Duke. And this one's called Thinking in Bets, same author. She told a story of taxi drivers in New York City. It was a study of taxi drivers. And what they found was that taxi drivers in New York City, when they get the cab, they're renting the cab on a 12-hour schedule. So 12 hours. So the taxi is split basically by rented to two people over the course of the day by the leasing company. So they lease it out and you pay a fixed amount of money to have it for 12 hours. So let's just say, for example, it's $1,000. I don't think it really is, but whatever. Let's just say it's $1,000. So now the taxi driver knows that they have to make back the lease that they paid plus fuel, and then they've got their time, right? They want to have a profit. So in order to catch their profit, let's say their profit goal is $200, they need to do $1,200 in pickups. So what the study found was that as soon as they hit that $200 profit goal, they were done. They stopped driving. Even if they still had 6 hours left on their shift, they would just stop right then and there. They hit their profit goal. And yet on days when nobody was looking for a ride, whatever, it was just a really quiet day in the city, they couldn't pick up any fares, they would do the full 12 hours. And what she found is that if in fact they drove longer on the days when, the cabs were popping and people were, looking for rides, like when there was something happening at Madison Square Garden or whatever the case is, that they would have made significantly more money, even if it meant on the cold days, they didn't work the full 12 hours. On the cold days, they just stopped and gave up. Now, it feels counterintuitive to say sometimes the best thing is just to throw up your hands and say that's enough. But in trading, it is very similar. When the market is cold, sometimes the best decision is to say, I'm going to sit on the sidelines. I'm throttling way down. I'm sitting on the sidelines. I'm going to wait for better opportunities. They will come along. They always do. This isn't the time to be aggressive. And then on the other hand, when the market's hot, that's the time to dig deep and spend an extra couple hours in front of the screen and see if you can squeeze as much as you can out of the market. So this is one of the downsides of being a trader, maybe like being a taxi driver, but probably a little different, is that when things are going well, you can have big swings up and then it can kind of slow down. And so these slow periods can last for a while. What we want to avoid is going like this. So what we basically do is we ride the hot period, and then when it slows down, we go on the sidelines. And then we get the next hot period, and then we kind of go on the sidelines. Then the next hot period, and we go on the sidelines. And if we look at my trading over long periods of time, that's exactly what my metrics will show you. So we're going to go down here. I'm going to cancel this out. We're going to go to win-loss expectation, and I'm going to show this to you over the past 10 years. So this will be 10 years of trading data, and what you're going to see are these extended periods. Slower, and then a crazy hot market. Slower, and then a crazy hot market. And guys, we're in one of these crazy hot markets right now. And I don't know how long it'll last. Maybe this is it. Maybe it goes for another 2 years. We don't know. But what I can do is I can show up every single day. Rain or shine, just like the mailman, I show up every day because I don't know what the market's going to give me. And I've learned that things can just switch on a dime. Very quickly, we could see a stock that starts to squeeze up. And next thing you know, boom, we've got to move, just like what you saw back here on BSLK. Out of nowhere, stock goes up 500% on the day. And this could be an incredible opportunity. So you got to show up every day. And I really think you're doing yourself a disservice if you're using fixed positions on every single trade you take. You are in charge of how much risk you're taking. You've got to be able to manage your risk, and in a hot market, size up and capitalize. But in a cold market, take your foot off the gas. So it's your job to be paying really close attention to those subtle indicators in the market that things are heating up and things are cooling off. You learn to pay attention to that, and things are gonna get really exciting. Thank you guys as always for tuning in. I hope you enjoyed this episode, and if you did, you hit that thumbs up, you can subscribe to the channel, and I'll see you for the next upload right here real soon.